All right, let's talk about a real head-scratcher. You've got a company, Sportradar, a giant in the sports data world. They come out, report what looks like a decent quarter, they even raise their guidance for the rest of the year, and then the stock just craters. It makes no sense on the surface, right? So in this explainer, we're going to dig in and figure out exactly what was going on.
And this slide, this just lays out the whole contradiction perfectly. On one hand, you've got management saying, hey, another quarter of strong execution, we're raising our guidance. They're painting this super positive picture. But then you look at what the market did, and it was the stock's worst day since its IPO. It's like the C-suite and Wall Street were looking at two completely different companies. So what did the market see that management was either missing or downplaying?
Yeah, and look, we're not talking about a little dip here. The stock got absolutely hammered, down 8.6% in a single day. And the trading volume, it was huge. That tells you that this wasn't just nervous retail investors. We're talking about the big institutions, the big money heading for the exits. So that's the big question we need to answer. What spooked them so badly?
All right, so let's get into it. We're going to go behind the headline miss. It's time to put on our detective hats and really unpack the numbers that sent investors running for the hills. Okay, so let's start with the top line, revenue. Now, to be fair, revenue grew 14% year over year. That's pretty solid growth. You can't really complain about that. But here's the problem. Wall Street was expecting 301 million euros, and the company came in at 292 million. It's only about a 3% miss, so not a disaster, but it was the first crack in the story, the first sign that maybe things weren't as perfect as they seemed.
But if the revenue miss was a crack, the earnings miss was a crater. This is where things really went south. The consensus was 9 cents per share. They reported 7. Now, that might not sound like a big difference, but it's a 22% miss. In a market that is obsessed with profitability right now, a miss that big is a huge red flag. This right here is what really hammered the stock in the pre-market.
And then if you dig even deeper into the official by-the-book GAAP profit, the number looks even worse. It was down a whopping 36%. But, this is one of those times where you have to look under the hood. The main driver here was a 22 million euro hit from foreign exchange. Basically, currency movements went against them. It's not really a reflection of the core business's health, but let's be honest, a headline number like profit down 36% is going to scare people, no matter what the reason is.
Okay, so that's the bad news. That's the stuff that drove the stock down. But now let's flip the script and look at the long-term growth story. This is what management was practically shouting from the rooftops on their earnings call, and what they really want you to be focusing on.
And here's Exhibit A for the bull case. Their adjusted EBITDA margin hit a record 29%. Now, without getting too into the accounting weeds, this is a key measure of profitability. And seeing it not only grow but hit a record high, that's a fantastic sign. It means the business is becoming more efficient and more profitable as it gets bigger. This is exactly what long-term investors love to see.
Then you've got this IMG ARENA acquisition, and honestly, this deal is kind of wild. It's one of the most unique deals I've seen in a while. So get this, they acquire all these super valuable sports rights, and not only do they not pay for them, they actually receive around $225 million in payments and pre-funded rights from the seller. Think about that. You buy a house, and the seller pays you. It's an incredible deal that's set to boost their growth and their margins without costing them a cent up front. It's a total game changer. And look, the CEO himself, Carsten Koerl, is all in on this. He's calling it highly strategic and says it's going to fuel our next leg of growth. You can hear how confident he is. Management is basically saying, hey, we know you're focused on this one quarter's miss, but you're missing the forest for the trees. This deal is the future, and they're betting the market will catch up to that reality sooner or later.
And the bull case just keeps getting stronger. Look at this list. They raised their full-year guidance for both revenue and EBITDA. They're churning out cash, a solid $65 million in free cash flow just in Q3. They're so confident, they're buying back more of their own stock, upping the program by $100 million. And maybe most importantly, their customers are happy and spending more, with net retention at a really strong 114%. They're even rolling out cool new AI products. Operationally, it's hard to find a flaw.
So this is the dilemma, right? This is why the market sold off. You have these two completely opposite stories fighting it out. You've got the short-term pain versus the potential long-term gain. How do we make sense of it all?
Let's just lay it all out here. The bull case is all about the future. The guidance raise, those record margins, that incredible IMG deal, and strong cash flow.
The bear case is all about right now. The Q3 revenue miss, the EPS miss, that ugly-looking GAAP profit drop, and maybe some worries about rising costs. And on earnings day, the bears, well, they won the battle. The market was in a show me, don't tell me mood, and the misses today just weighed more heavily than the promises for tomorrow.
And here's a really crucial piece of context. You can't forget that coming into this report, the stock was up almost 50% for the year. I mean, it had been on an absolute tear. And when a stock has a run like that, expectations get incredibly high. You're priced for perfection. So when Sportradar delivered a quarter that was good, but not perfect, there was just no room for error. The slightest disappointment was enough to send people rushing to take profits.
All right, so that brings us to the big finale, the next call. The stock is pulled back, the dust is settling, so what happens next? Let's put on our analyst hat and make our prediction.
Okay, our rating on the stock is market perform. Now, what does that mean? It basically means we think the stock is likely to perform in line with the broader market, say the S&P 500, over the next year. Not a strong buy, not a sell, but neutral.
So here's the thinking behind that rating. Our core thesis is that the long-term story here is still absolutely solid. That IMG deal is a game changer, their AI products are exciting, the foundation is strong. The headwind, though, is that the Q3 miss really damaged near-term sentiment. The stock's momentum is broken. So our prediction is this. We expect the stock to be pretty range-bound for the next few quarters. It'll probably chop around sideways as the market waits for proof. They need to see management actually execute on that higher guidance and show that the IMG integration is going smoothly. It's now a prove-it story.
And of course, please remember, this is not financial advice.